Welcome back. We've got Dhiraj Sachdev also joining us this afternoon. And markets right now still up about 0.5% or so. Sensex doing a touch better there than the Nifty right now. Dhiraj, good to have you with us. Where should we start? We've got some action now coming back after that cool-off that we saw yesterday, particularly in IT and pharma. We've had all the IT numbers, or most of the heavyweights now having delivered and far ahead of expectations.
Yeah, hi, good afternoon. So we have seen a fairly decent amount of rally over the last 6 months or so. And it again, validates the point that market always precedes economic reality. And we are just beginning to witness significant month-on-month improvement at the ground level. So in general, market has been rightly focusing on beyond short-term demand issues and seems to be factoring in fast approaching normalization across many businesses. Now, we know that many high-frequency economic data such as e-way bills, power consumption, online payments, etc. have indicated sharp improvement. And activity levels are currently at about 85 to 100% levels. Even September GST is indicating of being at 6-month high, while exports has grown after 6 months of fall. So the point is that, we are witnessing many businesses coming back on track. Factories are opening up. Even housing sales has rebounded across top 7 cities with some reduction in unsold inventory. So while we may claim that part of the demand is pent up and inventory filling ahead of the festive season, what is important is to monitor it whether this demand will sustain post the festive season is over. But nevertheless, from a valuation perspective, I believe the erstwhile polarized market is becoming even more broad-based. In mid and small cap specifically, mean reversion of distressed valuation is happening deeper down the market cap curve. And we believe out of favor value opportunities still exist and will outperform expensive quality stocks going forward. I mean, that's the view that we are carrying at this point of time. And we still find large number of companies still available at 6 to 10 times their normalized potential operating cash flows, even though their near-term earnings will reflect muted but sequential revival. So in short, market will continue to be broad-based and any correction at best will be short-lived.
Okay, great. HDFC Bank, we're watching out for that one now for earnings as well, Dhiraj. And it's had a pretty good run of late. It's always been a steady performer, of course. But, ahead of earnings, just want to touch base on that one.
So it can't be stock specific, but suffice to say that financials, this is not only key quarter, but also the next quarter will be the key where it will reflect many issues, whether the borrowers are willing to pay post the moratorium period is over. I think that needs to be monitored very carefully. But by and large, private banks and financials offer very high margin of safety, provided their asset quality book is secured and adequate provisioning has been done even before any kind of shock is noticed post the moratorium period. We do believe that in financials, as normalcy in business is coming back, the collection efficiency to improve gradually. At this stage, would have preferred private lending companies or banks, including housing finance, those who have low exposure to builder loan. Even microfinance companies being unsecured are at risk, but given that their target market is rural lending or agriculture, which are in essential category, they will relatively screen through reporting any higher number of NPAs or NPA issues. So overall, financial services may go through a volatile phase in the near term, including large private banks, because for the first time after many years, they are expected to see some kind of slowdown in the offline businesses, retail businesses, MSME businesses. So the exposures or the asset quality needs to be monitored very carefully in this tough environment.
Dhiraj, wanted to understand where you are currently when it comes to steel as a story. I was just reading one of the reports this morning which stated that post the hike this month, Indian steel prices have risen by about $20 to a ton. Having said that, they're still at a 4% discount to the landed Chinese imports. Hence, perhaps justifying the enthusiasm that you're seeing on the likes of Tata Steel, JSW Steel, for instance, today. But do you believe that this is a long-term story and an investment bet?
See, metals is another space where valuations had turned attractive and it is still attractive. We are seeing commodity prices on an uptrend both for ferrous, which includes steel, and non-ferrous and precious metals. We expect the metal sector to show strong growth in earnings led by a recovery in realizations. And you're right that steel prices have gone up by $20 in a month. In fact, it has gone up by 3,800 to 4,000 rupees per ton over the last few months. So profitability and margins will see very steady improvement. Besides, the global demand has improved, especially from China, including we expect the domestic demand will be driven by recovery from Indian automobile sector and construction sectors for the steel players. So, but preferred companies with integrated operations, cost competence, and cash flows here. So overall, any kind of commodity is never an investment. It is more of a trade. But yes, I think this trade will play out well for the next few quarters at least.
Sure is playing out today. You've got Tata Steel, JSW Steel, both holding out quite remarkably. Now sitting at a 6% gain for JSW Steel, and Tata Steel as well is clocking gains of 6% as we speak.
That's one of the stocks in news this afternoon. Just taking a look at some of the others now. And it's a pretty good breadth from what I can see so far. We've still got a couple of the IT names cooling off, so like a Mindtree, L&T, Infotech, HCL, even post earnings. But other than that, it's okay. On the upside, Pharma's back in action today. We talked about a Muthoot. Voltas is up 4%, so definitely seeing a move coming in there. Ashok Leyland is also up about 3.5%. Auto really has emerged as one of the themes that should possibly not have been ignored. The way the way things have shaped up, Dhiraj, over the last few weeks. Whether it be optimism or whether it be the economy recovering faster than expected. But clearly some of the auto majors have surprised.
With pent-up demand and preference to avoid public transport. I think that's a major thing which is expected to drive personal mobility trends moving forward as well. I mean, online car purchase inquiries from potential buyers are up by 15 to 18% over pre-COVID February month as per Google data. I mean, rural demand will also drive auto sales given that we had very fairly well-distributed good monsoon across states. So in sense, we also like auto ancillaries like tires that have good mix of both OEM and replacement demand. But by and large, two-wheelers and cars are expected to continue and sustain their sales momentum and growth, given the preference for public transport, to avoid public transport and personal mobility.
Both of you, thank you so much for joining us this afternoon. A whole host of other movers. Metals, as Kunal mentioned, clearly a theme. Tata Steel up 5%, JSW Steel up 5%. Maybe we'll come back and talk about that in just a moment. Do stay tuned, lots more coming up.